Good morning, everyone, and welcome to Power of Attorney with Latanya Moore. Guys, I am super excited about today's show because I have the fabulous opportunity of having Mr. Safir Malik, who is a CPA. He's actually my CPA. He's also the Chief Financial Officer of the Jones Accounting Group. Now, Mr. Malik has an expertise in resolving tax matters and representing clients before the IRS. Hopefully, you guys don't have any of those troubles. However, I asked him to come on the show today, guys, to talk with us about the new tax changes and how those tax changes are going to affect people like little old me and big old y'all. So please help me in welcoming Safir Malik to the Power of Attorney Morning Show. Welcome, Mr. Malik.
Thank you, Ms. Moore. I appreciate the opportunity to be here this morning. Just kind of educate your guests on the new tax laws that are going to really affect everybody.
Oh my God, you sighed now. You did a sigh. You did a sigh. It didn't sound like a sigh of relief.
Some more than others. It's going to really affect a lot of people. Some in a positive way, some in a negative way.
Whoo. So let's do this because I know that we're going to talk about individuals, some of the things that individuals may not know about that really are going to have some impact. And listen, guys, he can't talk about every single thing today. And I think that we know that, but you will have an opportunity to connect with him after the fact so that you can set up time for your consultation about your tax matters. So please just know that. Also, you may drop questions in the comment section, and even if we don't get to them live, we are going to be going back after the show and making sure that we're addressing those. So I just wanted you guys to know that up front. So, Mr. Malik, start with some of the taxes or tax changes that are going to be affecting individuals for this tax year.
Well, the first thing is that they actually raised the standard deduction. It went from $6,000 for single individuals to $12,000. It went from $12,000 for married individuals to $24,000. So, with that being said, they eliminated a lot of the other items, such as the exemption requirement for individuals, as well as for if you're claiming your children or you're claiming other dependents, such as your husband, your wife, your grandmother, or stepfather or cousins. They eliminated that dependent exemptions for people. So with that being said, when I did the calculations, the average individual tax liability is probably going to go up anywhere between $800 to $1,000. They also eliminated the educator expense credit, where they give school teachers that would buy school supplies for their classrooms. Normally they would give them $250, and then you could actually go, and if the expense were more than $250, you can actually go on form 2106. And I know I may be spewing out these forms like people actually know them, but let's just say if that school teacher spent $3,000 on school supplies, well, on the front end of the tax return, he or she could only write off $250, but on the back end, they could write off that remaining portion, the 2106. So that's been eliminated. So a lot of things with individuals, as such as the cap on your mortgage insurance, your mortgage interest, they put a cap on that. If it's more than $10,000, that's the max that you can write off, which some people it's not going to hurt, but majority of my clients, it probably will hurt. So overall, like I said, the individual tax bill is going to go up anywhere between $800 to $1,000.
Wow. Now, let me tell you why that is really just, I'm just sitting here like, what? And because you would think that they, with everything, you would think that the desire would be to have dollars back into the pocket of the average consumer. But it sounds like from an individual standpoint, all of the things that help people go from class to class, right, in upward mobility, are the things that's being affected. Is that a good assessment of sort of what's happening? What's your take on that?
Well, yes, it is. And what they did, what we have to understand, when we saw it on the news where they took the corporate rate, and which was originally 35%, and they dropped it down to 21% or maybe 20%, they had to take a lot of things away in order to do that. And so a lot of the things that they took away affected working individuals. And I'm not political or anything, but I will say this. I told my clients, I told just friends, that if this president got into office, that I knew that he was going to implement a tax plan that was very, very, very business friendly. I've been a CPA for almost 20 years, and this is probably the worst tax plan I've seen as far for individuals in my entire career. Now, businesses, great. That's, I mean, very, 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 very good incentives for businesses. A lot of loophole for businesses. It's just that the individuals were the one that actually kind of got it on this end. Unless, and like I said, I'm not political, but I've been hearing talks of the Democrats actually trying to come in and actually, repeal some of the things that were actually put in place. And, hopefully they can do that. I don't really get into all the political sides of it, but hopefully they can do that, and it will really help a lot of individuals.
Okay, so I'm sorry, I'm having some technical bottlenecking on my end. Can you still hear me?
Uh-huh.
Okay, great. So here's I think what is really interesting. So, my group, right, tend to be people that are in several different categories, but one of the main categories of people that I deal with are people that sort of like they work, they have their business on the side, right? What are some things that if they haven't done it, or if they didn't do it, may negatively impact them as a person that, you got your 9 to 5, your day job, your W-2 job, as some people say. But then on the other side, you got, the other things that you're doing. If you're a private consultant, you have your 1099, all of those. What are some things, how is it going to affect the side hustle group?
Well, it depends on things that they've put in place. If they have everything in place, such as if they went out and, let's say, for example, what I call don't be a paper business. That's let me just start off that way. Meaning, don't just have your business set up on paper, but you haven't done anything as far as purchase equipment. You haven't spent any dollars just besides setting it up. That's really not going to do you any good. For those who have took the proper steps and did everything as far as with setting it up, we know every day, all day, that businesses operate. You have to buy equipment. You have to buy things. You have to purchase things. For those who are actually purchasing items for their for their businesses, they can actually expense those items immediately instead of having to wait. So if they went out and purchased new equipment, new computers, or anything like that, instead of having to wait the 3 years or 5 years or however the IRS deemed the useful life of that asset, they can actually expense that item immediately. Even if they went in and had someone come in and do a lot of interior work on their business, if they had to refurbish an office or whatever, those items can be expensed immediately, which drastically lowers their tax bill.
Wow. So this is what I like about the conversation that we're having today about this, because I think that people watch the news and they don't go any further, or they get information, but they don't go any further to say, how does this really affect me? Now, I know that you've gone over with us about the things that that's going to be good, For us, someone in the comments said people need to start setting up more S corporations. I want you to speak to that before we really get into the meat and potatoes of what these tax changes mean for businesses.
Well, I mean, the S corporation is a good it's a good business structure. I personally, professionally, that's what our firm is set up as an S corporation. Because really the business, everything passed through the shareholders. Everything passed through the shareholders, the profit, the losses, and those things are allocated based upon the percentage of ownership. The S corporation is not taxed at all, as well as you still have that protection. You still have that corporate protection also. And depending upon what state you stay in, for me being in Alabama, the only thing our firm have to pay is just that $110 a year for operate in the state of Alabama. So the S corp is a great pass-through entity. It's a great way to kind of shift some of the tax load also, as well as bypassing the self-employment tax, which is 15.3% right now. So it just depends, on what the actual individuals are doing. But yes, the S corp is a great business structure. And I think that they will keep that around for a while because it benefits a lot of people.
So let's say that someone, so let me ask you this. So in light of these new tax changes that are business friendly, how does the S corp benefit in conjunction or in comparison to, let's say, the LLC, right? Because sole proprietor is that's just you, right?
Yeah. Mm-hmm.
That's just you, and you say you got a business, so we ain't talking about that.
Yeah.
Well, look at the S corp versus the single member LLC, or even I guess because the multi-member LLC is more like a partnership.
Exactly.
Talk a little bit about. Okay, y'all, let me ask the question right. Talk with us about how these new tax changes are going to impact the LLC, the partnership, and the S corp as people go and file their taxes, their 2017 taxes.
I mean, well, across the board, since all three of those are actual businesses and business entities, they will still benefit from the new tax laws. Now, when we get into the actual individual structure of each one, that's where it gets tricky. So they would still benefit if the partnership goes out and buys new equipment or have a lot of work done to the actual building or any assets. All those items can be immediately expensed. Like I said, instead of having to wait the 3 years or 5 years or however. That's across the board with any business entity. When we get into each entity, as far as the tax wise, like I said, the S corp, there's no taxation. Everything is just reported, and in the income and the losses are passed through to each individual shareholder, and it would be based on the percentage of ownership. So, for example, if the S corp made $100,000, it spent $50,000, and it has 5 partners. Each partner, if they have equal share, then each partner will actually get $10,000 reported on their K-1 form, which will flow to their individual form. As far as for the LLC, you're still going to be subjected to the self-employment tax, which is still 15.3%. So you're going to be subjected to, that's an additional tax on top of your regular income tax. So the LLC, which I initially started out as, and then I eventually switched over, still is subjected to additional taxes. However, if they went out and depreciated everything properly, if they went out and, saved their receipts and everything that they did, then it's still going to be better than the actual individual. And the same for the partnership. They get the same benefits. The tax just depends upon the percentage of ownership for each individual partner.